In this section of the lecture, I'm going to be talking about the Great Depression and in particular how this event came about. To start off with, I've chosen two quotes. The first quote is from Ben Bernanke, the current governor of the US Fed, but also one of the world's leading scholars on the Great Depression. And Bernanke says in the quote, to understand the Great Depression is the holy grail of macroeconomics. In saying that, I think Bernanke probably had in mind firstly that the Great Depression was a complex event, and it's been an event that economists have spent a long time thinking about. So I think partly he's using the word Holy Grail in terms of the challenge involved in understanding the Great Depression. But I think secondly he's also referring to the importance of the event, the Great Depression. That the Great Depression was in the 20th century the huge challenge to the operation of market-based capitalist economies. And so that really understanding about the sources of the Great Depression is a critical task for economists. And Bernanke's saying he thinks it's the critical task for macroeconomists. The other quote I've got here is from E.Y. Harburg, who says, this is the man who says, I built the railroads, I built that tower, I fought your wars, I made an investment in the country, where the hell are my dividends? And so I think that's saying a couple of things as well. First of all, it's telling us about the human dimension of the Great Depression, that this was an event that threw millions of people out of work, caused great hardship for their families, caused massive social dislocation. So it's important to remember that the reason we're interested in this event is because it had such a huge impact adversely on human well-being. The other thing I think this quote's saying is, I see it as bringing out sort of a sense of, or a feeling of injustice on the part of the writer about the fact that this Great Depression event could have occurred, and that its consequences were imposed on people who'd felt that they'd made such a big contribution to the country in a variety of ways in the years before. And that sense of injustice, I think, is really important because it tells us about why the Great Depression would lead to such a questioning of the market-based capitalist economy. And that's a theme that we'll take up in this lecture in a couple of sections' time. On the next slide, I've chosen pictures of two scenes that I think encapsulate a lot of what the Great Depression was about. On the left-hand side, a picture of a soup kitchen in Chicago, I guess making the point that this was a period when lots of people were thrown out of work and huge human suffering. And on the right-hand side, a bank run in Berlin. I guess making the point that a big part of this Great Depression episode was in many countries around the world significant instability in the banking sector, which also caused tremors throughout society in terms of people's feelings of confidence about the continued operation of their economies. What I'm going to do now is talk first of all about what happens in the US in the Great Depression. The US sort of, I guess, often a focus in thinking about the Great Depression. Then I'm going to talk about what happened in other parts of the world. So the US economy began contracting from July 1929. Industrial production sort of falls about 2% between then and October 1929. In October 1929, the infamous Wall Street stock market crash occurs, and when that occurs, it really accelerates sort of the economic downturn. So industrial production then falls in the US another 10% by the end of the year, and then falls a further 25% during the next 12 months. Very large declines in output and production by the standards of any period. This feeds into a series of banking panics which occur in the US, a series of sort of bank runs and bank closures that occur from 1930 to 33. And so the US economy really stays in depression through to 1933. There's a period of recovery from 1933 to 37. Then, because of some errors in policy making, there's what's known as the dip of 1937-38. And then the economy begins recovering again, and sort of in the early phase of World War I is back to the level of economic activity that existed sort of before the Great Depression occurred. This is a graph of US industrial output, which is benchmarked at 100 in the middle of 1929. So you can see that sort of with a couple of ups and downs, output, economic activity was basically increasing in the US during the 1920s. But then you get the Great Depression, which is this period where if we go sort of from the peak of 100 down to the trough, which occurs in 1933, you can see that basically industrial output, the amount of industrial goods being produced in America, it's fallen by over a half, down to sort of underneath 50%. Then there's the period of recovery from 1933 to 37. But then this dip of 37 to 38, which you can see actually was a pretty substantial downturn again, and then sort of recovery through to World War II. This is the implications of that sort of change in the amount of output for unemployment. So basically, back in the middle of 1929, unemployment's pretty low, about sort of 1 to 2%, but then during the 3 years of the Great Depression, you can see it increases to be up over 25%. It then gradually decreases down to about 10% by 1937, but then increases again to 20% during this dip of 1937-38, before then beginning to decline again. But basically you have a whole period in the 1930s when unemployment is just way, way above what it had been, for example, in the period of the immediately preceding the Great Depression. Here's stock prices, New York stock prices to be precise, indexed at 100 in 1926. You can see how the stock market prices kept rising, but then in October 1929, having risen sort of or doubled just since 1926, then have this precipitous decline, basically from over 200 down to around about 25, so falling by a factor of about 8. So that is sort of, if you held on average a stock on the New York Stock Exchange during this period, its value was cut to 1/8 of the value it was back in October 1929, before again sort of there's a recovery in the stock market. But in none of this period does it reach the levels that it was at before the stock market crash. What about the rest of the world? Well, here I've sort of included the United States with a range of other major economies. The blue line is the United States. This is, in this graph, it's sort of the cumulative difference in industrial production from 1929. So when you're below the line, it means you're producing sort of less than 1929. And so the US, you can see, goes like that, and then that after 1932-33. So the US amongst, because to be further down on this graph means you hit harder by the recession or depression. So you can see that the US is hit relatively hard by the Great Depression compared to other countries. You can see that Canada also sort of hit hard. Germany also hit hard, although Germany's sort of recovering a little bit more quickly. Then we've got countries that seem to have been affected but less affected sort of. So for example, United Kingdom, sort of it has a downturn but it's less and it recovers more quickly. We have Australia and Japan, which certainly have downturns but which again recover more quickly. And then we have the example of France, where initially the recession is sort of more mild than, say, in the United States and Germany, but which just doesn't recover through to 1936. So I guess the things to take from this graph are that, first of all, sort of almost all countries around the world to some degree were affected by this Great Depression, and it was a major impact. So even though the impact might have been bigger in the US, you're still talking about an effect in places like Australia and Britain of 20% or so decline in industrial output, which is a major decline. So first of all countries are affected to a greater or lesser degree by the Great Depression. Secondly, there's diversity, though, in the extent to which they're affected, sort of. Some countries were hit sort of extremely hard. Other countries were hit sort of hard, but less hard. Some countries sort of recover relatively more quickly than other countries. Then there are countries like France, which seem to just have a different trajectory, sort of, taking a much longer time to recover, say, than any of the other countries. So there's a common point here about this being a worldwide event that adversely affected economic development in a variety of countries, but there's also a story of diversity there. What I'm going to do now is talk about the sources of the Great Depression in the US and then move on and say something about the sources of the Great Depression in the rest of the world. So the initial downturn in the US in that period from sort of mid-1929 to when the Wall Street crash occurs seems to have been mainly driven by tightening of monetary policy by the US Federal Reserve from the beginning of 1928. So the Federal Reserve was concerned about what it thought was a speculative bubble on the stock market, and so tried to reduce the extent of that bubble by reducing money supply, tightening monetary policy. That seems to have had the effect of reducing economic activity. For example, in 1928, housing construction falls and new automobile registrations start to fall during this period. So the US economy sort of is moving into a mild downturn because of the policy from the Federal Reserve. Then there's the stock market crash. The stock market crash has these massive effects on wealth, reducing people's wealth, and causing uncertainty about sort of what's likely to happen in the future. And that reduction in wealth and the increase in uncertainty have big effects on demand for consumer goods. So here, consumer goods are divided up into durable goods, white goods, for example, semi-durable goods and perishable goods. And you can see that what happens is that basically the demand for perishable goods sort of falls away a little bit between, for example, 1929 and 1930, but the demand for durable goods falls massively, sort of. So that's things like cars and white goods that households might have been buying. And so basically for these large items of expenditure, people just start delaying them because their wealth's reduced or because they're uncertain about the future, about, for example, whether they might be thrown out of work. So this contributes to a big decrease in the level of demand in the economy, the reduction in wealth and the uncertainty that's existing in the economy. So these effects of the Fed tightening monetary policy and the Wall Street crash causing a reduction in wealth and demand, it leads to deflation, to reductions in prices. And that deflation has a couple of effects. First of all, it reduces the net worth of potential borrowers, so it makes it harder to borrow, but also reduces the value of collateral at banks. And that causes concern about the solvency of banks, about the capacity of people who banks have loaned money to repay their loans. So people who've lent money to the banks become concerned about the solvency of banks. And so the US experiences a succession of banking panics between 1930 and 1933. Basically, 1/3 of America's banks close in less than 4 years during this period. And so these bank closures mean that there's a big reduction in money, in the available money supply. First of all, because there's less banks, which holding bank deposits and bank failures. Secondly, people are hesitant to deposit with banks. Banks become more conservative in their lending strategies because they want to maintain a larger ratio of cash on hand to the money that they're loaning out, so that they're better able to defend against potential bank runs. The fact that some banks go out of existence destroys relationships between borrowers from those banks and the people who ran the bank, and so that means that there's a loss of information about the creditworthiness of some potential borrowers, which also arguably makes it more difficult to borrow money during this period. So for a whole variety of reasons associated with the decline, with the banking panics and the closure of banks in the US, the money supply is reduced further in the US. And this is exacerbated by Fed policy to respond to other countries moving off the gold standard in the early 1930s. So, for example, when Britain moves off the gold standard and devalues and gold starts to flow towards Britain, the Fed tightens monetary policy again to try and increase interest rates to reduce those flows. So basically, during this period in America, there's a variety of reasons why money supply is reduced, and that gets translated through a variety of channels to real output via, for example, consumer demand, via demand for investment by businesses. What about the rest of the world? Well, as I pointed out before, every country is different, but we can see some common themes. First of all, a lot of other countries in the world at this time were major agricultural producers, producing for export to the rest of the world. And from the mid-1920s, there's a big increase in the supply of commodities, foodstuffs, but also other types of commodities which they were producing, which causes a big decrease in prices. So if we sort of take an index of 100 in the prices of commodities from 1923 to 25, then by 1928, that index had fallen by about 25% to around about 75. By 1930, the end of 1930, the index has fallen by about 60% to about 40, and by 1932, it's fallen by 75%, to be around about 25. So countries which were major producers of agricultural and other commodities experienced very large declines in the price at which they were able to sell those commodities at on world markets before and during the Great Depression. So this exerts sort of a downward effect on economic activity in all of those economies. Then there's the effect of the gold standard. So going into the period of the Great Depression, there are major imbalances in holdings of gold. So basically, France and the US hold a disproportionate share of the world's gold. In the case of the US, who hold about 40% of the world's gold at this time, it's because they're such a large producer who the rest of the world is trading with, and also because of repayments to them from money they'd loaned to countries during World War I. In France, it's because France, when it goes back onto the gold standard, does it at a devalued currency rate, and so there's a lot of inflows of gold towards France because of the way that it's gone back onto the gold standard. Those flows of gold to France and the US have a deflationary effect on other countries in the world. So to try to offset, to ameliorate, to turn around the outflows of gold to the United States and France, other countries in the world are forced to, for example, increase interest rates and deflate their economies. This is a table which tells you about what was happening to the world's gold reserves during this period. You can see that sort of in the 1920s, up until the Great Depression period, France had been accumulating gold. The US had been sort of offsetting that to some extent. But during the Great Depression, when the US adopts this sort of more restrictionary monetary policy, then gold starts flowing towards the US. And with gold still flowing towards France, that means that gold is then going to be sucked away from the rest of the world. And so they have to respond to that by deflating their economies. So it's often said that the Great Depression is sort of transmitted via the gold standard from the United States and France to the rest of the world. And Douglas Irwin, in a paper in which this table is taken from, has calculated that the world gold supplies in this period of time were actually increasing. And he calculates that based on what had happened in previous time periods, that those increases in gold supply would have led to increase in world prices averaged across the world of about 15%. In fact, they decreased by 40% sort of during the period of the Great Depression. And he calculates that about a third of that can be attributed sort of to the US and France having brought so much gold into their country sort of during that period. So the story is there's a major deflation for the world, for the rest of the world during this period, and a sizable proportion of that is due to sort of the gold standard transmission mechanism from the US and France to other countries. And it's often been pointed out that this was a very different world to sort of the way the gold standard had operated previously. Previously sort of, there'd been an understanding that the gold standard would operate sort of in a more cooperative way, that it wouldn't sort of in this almost deliberate way impose deflation on countries through the actions of any country or countries in the system. But in the Great Depression, sort of the role of the gold standard as a cooperative system fell apart. Due to the two forces I've talked about sort of already, the agricultural depression, the deflation being transmitted sort of via the gold standard, many countries sort of around the world experienced banking panic sort of in the early 1930s. So this begins in Austria with the run on the Kreditanstalt, and then within 6 months there are bank runs in 18 different countries. Studies which have been done of these banking crises have identified several factors that appear to have been associated with where banking panics were most severe. First of all, there's the nature of the banking sector. So countries where there were branch banking, diversified banks seem to have experienced panics less than, for example, in the United States, which had the unit sort of undiversified banking structure. And also countries where banks were more integrated through sort of extensive lending to the corporate sector seem to have been more exposed to banking panics. Secondly, countries that relied relatively more on capital flows from overseas or from offshore were more exposed to banking panics, because during the Great Depression often those sort of international capital flows would be cut off suddenly, and so banks which, for example, were borrowing from overseas would then have that borrowing cut off, and they then perhaps couldn't continue to finance their operations. The other factor that was really important was history, sort of. Some countries had restructured because of banking problems in the 1920s. For example, Japan had restructured their banking sector sort of, and so their banking sectors were in a better position to withstand the stresses of this period of the Great Depression. Countries that had a greater involvement with the international economy, so that were more involved with trading goods and services to the rest of the world, or more reliant on borrowing international capital, they seem to suffered more during the Great Depression because of the way that the Great Depression was involved with a contraction of world trade. And another factor that's often identified as an important factor in the Great Depression is the absence of downward adjustment in wages and prices. So there'd been this big reduction in demand in the economy, and there's two ways that an economy can adjust to that. It can adjust by on the quantity side or the price side. So or obviously a combination of the two. And what seems to have happened in the Great Depression is predominantly there was a downward adjustment on the quantity side because there was a relative degree of rigidity in wages and prices during this period. Here's a graph which shows the contracting spiral of world trade from 1929, the beginning of 1929 to early 1933. And so each line sort of is a month. Each point tells you about the total volume of imports to a sample of countries that were used sort of by the League of Nations to construct these data at that point in time. And so each of the lines is a particular year, and I guess the point to note is that as we get to later and later years, the lines move in and in. So here's 1929, here's 1930, here's 1931 in January, here's 1932 in January, here's 1933 in January. So basically, as time goes on for any particular month, the amount of global trade, the amount of imports being traded by different countries to each other is significantly contracting. So this was also a factor that exerted a negative influence on economic activity in countries that were in particular involved in international trade during this period. In the next part of this lecture, I'm going to go on to talk about the period of recovery from the Great Depression.